Okay, this is Carl Dieter, and I'm going to talk you through some of the coverage in recent days about a proposal by the IMHO which suggests that there should be a state-sponsored split mortgage scheme. The first thing you're looking at here is a picture of an article penned by David Hall of the IMHO where he describes how it might work. He speaks about a €200,000 mortgage with the property at a lower value, that it would be split down into an affordable portion, another portion would be parked at 0% interest for the lifetime of the loan, and that by paying what the person couldn't afford, in other words they could afford 300 and then the state would pay over and above that to make the mortgage payment on the split portion, that it's cheaper than rent allowance. This was covered more in recent days by Kieran Hancock in the Irish Times, carrying a broadly similar story of how it would work, the machinations of it, and the headline of that one was called "State-Run Split Mortgages Urged by Home Loan Body." If you want to look it up, you can put that into Google and you'll find it straight away. The overriding message is that if they were to do this, it would be cheaper than providing $925 per month in rent allowance or rent supplement. For a start, this ignores a few things. First is that you would need up to $925 per month. I'm not sure what that is applicable. It sounds like it's the top amount that could be applicable and likely for a 4-bed house. It also then strips away the fact that if the person can afford 300, then really they're looking at renting a place that's more like €1,200 if they can get 925 from the state. So the first thing to do is to consider the sums, because that's always important. We'll look at that example of a loan balance of €200,000 that was used in one of them. And what you can see is that there's two options out there. Broadly, people might be on a tracker mortgage, and rates are typically about 1.1%, or on a variable rate mortgage where rates are about 4.2%. The maximum term, which is how long you can get your mortgage extended out for, we'll assume is 25 years. And that's broadly consistent with the figures that were being used by the IMHO. What you see here is that the monthly repayment on a full €200,000 is $763 if you're on a tracker and $1,078 if you're on a variable. If you were to be on interest only, it'd be $183 or €700. The IMHO proposal is that the rent allowance applicable, I think they said it'd be €925, I'll change that, and that the person has affordability of €300. Well, if they were to put tranche A in there, it's 70% of it, giving you that 140,000 figure. The monthly repayments would be $755. Again, very consistent with what they wrote about. The monthly repayment, if it was a tracker, would only be $535. But here's where we get down into a few of the different choices. If the state was to support a standard variable, they would be paying $455 on top of what the person could afford, which is at €300. Now, there's two things. A is that when the state pays that, they're actually helping make that loan amortize. In other words, they're paying capital back, and that creates wealth for the individual, not for the state. So apart from providing housing, you're actually improving their balance sheet. There's also the notional value of the split, because if a bank hives off a certain amount of money at zero and you don't have to pay that, while it's not a benefit in kind, I just factor that in to say that the benefit to the person is about €665, but the actual cost to the state is $455. Don't forget though, the person will be capturing part of that as their own wealth. If it was a tracker, the cost to the state of supporting the split would be $234. Again, these two things look very, very reasonable until you look at what it would cost if you were to just service the interest. If you were to pay the interest, which is what mortgage interest supplement used to do, on a standard variable, it would actually be cheaper. It would be $400 per month. And that's this figure down here. And if you looked at interest only on a variable, the reason that figure is red is that the person would be able to afford it on their own. Because, let's not forget, see this 183 up there? That would be the actual cost. They can afford the 300 over here, and therefore they actually would need zero help. So the question is, when people say, oh, it will be cheaper, it's cheaper than the maximum rent allowance, assuming that the person has no affordability. Even by their own example, if the person could afford 300, why would you give them the maximum rent allowance of 925? It simply wouldn't make sense. It also beggars the question of why would a bank want to hive off part of a loan at zero, which reduces their income and means that someone who is servicing the loan will more than likely end up paying more, when by paying that money with the state down here, you're actually improving the person's wealth. You're not just providing housing, you're going a step further. The sensible thing is that you pay the interest and they stay in that home as long as the interest is serviced. No one is gaining or losing, particularly the people keep a roof over their head. Even with property prices going up, they still hold the benefit of capturing some of that gain too. And that's really what this whole thing falls down on, is it's not the cheapest and it's probably not the best thought out. So it's worth considering when you see the headlines to think about this kind of stuff. Now, if you're to say to the person, actually, you know, that 750 that you mentioned in the article, what about if you didn't live there at all and you had to go live somewhere else? Well, there seems to be a decent selection of 3-bed houses in Kildare, as you can see from this, starting from €650. If you were to give them the 925 and they could add their €300 to it, they would be living in places like possibly this 5-bed place here, this 4-bed detached here. So you'd actually almost be putting a person beyond where state help should really have them. And that's why it's really important when you see things like this in the paper or mentioned to see if the person has done the sums, because if all they did is provide a small working, which is, oh, A, B, therefore C, it kind of gets beyond where a lot of the nuance in this is. And the nuance is that for anyone on a tracker, this makes no sense. They should just be put on interest only. And for people on standard variables, in many cases, it makes no sense to go to all this effort to split mortgages and have the state involved when they could just get long-term interest only. A fact of banking that a lot of people don't realize is that for any given pool of lending, it doesn't matter who holds the loan. What matters is that the bank is collecting their interest. So if a bank had €100 lent out and it was collecting 4% interest, they get €4 a year. Well, that doesn't matter if it's lent out to one person or 100 people. Stripping away the fact that managing €101 loans would be expensive, but the general idea of it is that as long as they're receiving the interest. And so this isn't pro-bank or pro-borrower. It's simply pro doing what works best, fastest, and is cheapest. And that's really what we should be looking for.